the Asian session displacement that was appearing on the chart yesterday, that's this right here. That's a displacement. And another imbalance on here, that was an inversion fair value gap. It's this right here. So with that bit of housekeeping out of the way, all right, so we were going on about a couple things yesterday, and I talked about how the market would likely utilize the Asian session buy side liquidity. And while it was going on, it used the 7 a.m. pre-market start time and then the first percent fair value gap there. And I talked about how that little tiny little gap there wouldn't be represented by me in my analysis as the first percent fair value gap because it doesn't cause displacement. But if you look real close, sticking to the rules that I teach with my fair value gap, this imbalance right there is the one I talked about being, that's the one. That's the first percent fair value gap during pre-market session hours. That means 7 o'clock to 9:30 opening. So that 2.5 hour window of watching price action, what you're going to get from this is the rules I've already shared are consistent, but my focus, okay, my interest in the market is zeroed into a very specific candle, a very specific time of day. And while this little area down in here, if you note that high and that candle's low, you can see it did work that, but it's only the wick. Okay. So some of you may say, well, look at this. ICT got it wrong because it went down to the first gap after 7 o'clock, because here's 7 o'clock right there. That candlestick, the one with the little wick above it. And then here's 701 and 702. That little gap, I'm not interested in that. But now watch what happens, okay? That gap is a common gap to me. This is the first presented fair value gap because it displaces above this high. This displacement is technically it's a shift in market structure, okay? This candlestick gap right there, if we were using, as I teach it, this is the first presented fair value gap. So you have to use candlestick number 1 because this is number 1. Number 2 is the imbalance or inefficiency. And number 3 is the close of the 3 candlestick pattern that frames the imbalance in the middle, or candle number 2. Candle number 1 in a bullish fair value gap, candlestick number 1's low is the stop. This gap here, the real one, that is candlestick number 1 here. So the stop is there. Was it in jeopardy? No. The body stayed inside of the first positive fair value gap as I called for. And this little inerrant wick, okay, it's permissible. Why? Because there is a small common gap there, but the stop loss is down here. So the logic still holds true. Okay, when we use fair value gaps, bullish ones, the stop's got to be below candlestick number 1's low. When we're looking at bearish fair value gaps, the stop is above the high of candlestick number 1. Very, very simple. So that was that. And then I talked about how this idea, this diagonal, quote unquote, trendline support, I talked about that being a trendline phantom, and it's a retail diagonal support fallacy. This trend line would be the liquidity that the market would seek. And this was the first presented fair value gap. So relative to time, this is where you anchor to, and the price and liquidity agree with both. So the stops below here, they would target that. It's the midpoint of the trend line phantom. Whenever you see a trend line, I look for 3 points where it is trying to gravitate to. The liquidity resting below that very specific low right there, that's what we're going to target. Okay. And then the market opens, it trades down into the fair value gap that I called as first presented fair value gap, and the liquidity is absorbed. there. And just for good measure, it goes right into that little tiny little common gap, but never breaches the low of candlestick number 1 that frames the actual first presented fair value gap in pre-market session hours, which is 7 a.m. start time, Eastern time. Also, I said, what about this imbalance here? Okay, what would you do with that? Would you go short with that? And I said, no, because we're in a holding pattern. What does that mean? If the market's likely to go higher and we were using the 26,133 half on the daily chart, those relative equal highs, as the higher time frame draw on liquidity, to frame the basis of what direction are we trying to trade in. Now, there's all kinds of fluctuations. There was short trades yesterday a couple different times, but the best moves are going to be framed on the higher time frame daily bias. But having the idea of looking for the daily candlestick to extrapolate to the upside when you're bullish and only trading on that side affords you the luxury of finding these big running moves that just take off, and they're just really fun to be a part of. But you won't ever catch them if you're trying to just trade on every little minor fluctuation on the daily chart, ignoring that bias and only trading the internal little, like this is a minor here, and you can go short on this fair value gap there at the Asian session buy side liquidity pool. That right there, sure, you can trade that. But what happens if you don't take profit there? What if you didn't know what I was outlining yesterday, which was the liquidity below here, and that's what I talk about. It's the liquidity, and here is the range at which price is going to go to. So liquidity, price, time. See what happens? So every time I'm looking for price action and moves, the algorithm is doing the same thing. It's just like a multiplication table. It's finding time and price, and when they meet, this is what you get. So this inversion fair value gap, I said that you wouldn't use that to go short because it's a holding pattern. Holding pattern for what? It's going to use the 9:30 opening range to 10 o'clock to then start running bullish using the liquidity that I outlined here, breaking this trend line support, upsetting those individuals that are buying here, buying here, buying here, anticipating this being a breakout to the upside. They have to come down first to absorb this liquidity I talked about into that first presented fair value gap. And then you get it here. Okay. Look at the delivery on that candlestick right there. It opens at regular trading hours, opening range low, trades to the low of the inversion fair value gap here. It was a sell side imbalance, buy side efficiency with a volume imbalance at the low of it. Anything trading up into this, only if it drops from there, is a short-term fluctuation. Now, that's beneficial for you to read the tape. Does it offer that? Yeah, but look how muddy and dirty it is because it was part of a holding pattern that will release that holding pattern when the market opens at 9:30. And then the market rips through. There, we open, trade down to the low of that inversion fair value gap, some random volume imbalance. Okay. If you recall, when I first started teaching volume imbalances, mentorship students, the idea of using volume imbalances inside of old price action, I would take their attention right to that and not show this entire range. It would just be pointing to that. But that volume imbalance right there would be an example how I would, in the past, only look at that right there. But it's part of the whole grand scheme of this inversion fair value gap. The inversion aspects of using them as the opposite of what you expected when they first formed. So a SIBI is usually, when you're bearish, something to sell short in. But what happens if it overtakes that? So if you're expecting a Judas swing going lower, you're going to look at that fair value gap that's a SIBI, sell side imbalance, buy side efficiency, or a down closed candle. You want to wait for it to be overtaken and then use it as a foothold to push and to propel price higher, as you see it does here at the break time at 9:30. Price, time, agree. The range, the price, the time. Perfect. Simplifying it and saying, okay, I just want to know where it's going to go. what time it's going to get there, and should I buy it or sell it? That's it. That's all we're doing, folks. That is not complicated. We're looking for a long-term, higher time frame draw on liquidity and where it's going to go. So ultimately, you see it rips off, tearing off into that, and there's that 1040 I showed you, inversion fair value gap that we extended forward. It went into that. It's an eighth, by the way, if you look at that on that. And then I talked about up here how before the market ran out there, I said this is new week opening gap, and the regular trading hours opening range gap high where we settled previous was here. So we had new week opening gap, regular trading hours, previous settlement was this purple line, and it went right up to it and hit it perfectly. It's all control. That right there is a minor sell side liquidity pool. And that was where all the stops were until this formed. And then they want to crank their protective sell stops on their longs right underneath that low. I don't want to see this low taken before it trades to the low of the new week opening gap. That's exactly what I said. But look what it does. It goes right to the price I said it was going to go, and then it drops down to that low. We ran up into new week opening gap, trades down below the low there, absorbs that, then uses the, what's this price right there? When it trades down into that, what is that right there? That's an eighth. So this level right here, that is the 7th daily high, old daily high. That's the liquidity they sweep right there. And then we break lower, we trade back down into new week opening gap. Overnight, they sink it down and worked inside the ranges and the levels I told you about. You can see it there. And now I just want to get right over here and watch the carnage. Look how they use new week opening gap again, and record trading hours, opening range gap high. So again, let's see if they drop it aggressively, the throw off sentiment, because that daily relative equal high is obvious to me, or do they rip it higher? There we go. You want to trade that? Remember that red line? That's January 7th old high. Everything I'm showing you here is as I sat and looked at the charts first time. That's what that is. So there's yesterday or Monday's high, regular trading hours high. Look at that move. It's all predicted by the economic calendar. So my question to you is, like, if you don't pay attention to the economic calendar, you're not aware that these things are they're gonna happen. And there are certain reports like CPI, PPI, FOMC, rate announcements, not the minutes. The minutes aren't like all that important. They're like cause a whole lot. They can. It's a rare thing, but you have to be aware of that. And they happen in the afternoon. So there's these times of days where certain economic drivers or volatility injections, I call them, where there's a medium or high impact. This is a high impact news driver. That means it can rip your head clean off. If you're offside, that means, let's assume that for a moment that you were looking at this gap here and saying, okay, I'm going to go short and look at this, I'm going to make money. And then you don't know CPI is coming out at 8:30. And in one candle, it's traversing from low of 905, well, 104 handles in 1 minute. Can you weather that? You can't, man. So you have to know what you're doing. If you suffer something like this, I'm telling you, it leaves such a scar that you will always be fearful of that happening. Even if you later find out that, oh, yeah, it's that report, it won't change it. It'll feel like it's waiting behind a tree right around the corner, waiting in that dark alley that you have to walk past, and it's going to come out and take your account from you again. So to go into this sober-minded, you want to just simply understand that there are reports that are released far in advance. You can look at what's going to be released next month already. That's how far away you can plan and say, you know what? I'm not going to trade the morning of PPI and CPI. I'm not going to do it. I'm not going to trade the afternoon of the FOMC rate announcement. Now, you can. I teach those things. I'm not saying you shouldn't do it. I'm not saying you shouldn't trade after 9 o'clock tonight, this morning. At 9 o'clock, I would go back in and start looking for trades. But you can't be in there ahead of 8:30 unless you have a higher time frame trade and you're really tamped down with unrealized profits and you've been in it for a couple days. which in this economic climate, I'm a little uncomfortable doing that. But here's the central core tenets. What I teach and what you're supposed to be focusing on is this. You're looking for a market that you want to buy or sell based on some higher time frame premise that leads to a direction to a very specific price level. An old high or an old low, singular, or relative equal high or relative equal low, or an imbalance above price or below price. And all you have to do is check what just recently happened. Was there a stop hunt? Did they raid the sell side? Okay, if they did that, look for some kind of a premium array. First, imbalance, because it's going to be inside of the range. It's going to climb back through. Then, is it a single high or relative equal high? And you do the same thing if it ran buy side recently. Is that complicated? You're met with 3 choices. Okay, it's multiple choice. It's this, or that. It's not all 3. It's not 2. It's just one of them. Once you arrive at that, then you go down to the lower time frames and you wait for a first presented fair value gap where I tell you they're going to form. I've taught you several of them. That's a finite point of reference. It isn't shifting and moving all around. It's not hiding from you. It's very specific information. The fair value gap has to displace. It has to be significant. It can't be just little common gap. And you use that as a point of entry. You use the first candle to use for stop placement. Along the way, you have already determined where you would take a partial. If you can't do partials because you're only trading with one contract, fine. Then you need to know where you're going to move your stop, graduating it, moving it, protecting whatever it is you have in terms of risk until you get inside of profit, unrealized, and then you manage it to the end of the trade. That's not hard, folks. That is not me complicating anything. What complicates it is because I have so many tools, so many ways for you to do that very thing. It allows you as the student to go in and say, I really don't like order blocks because there's so many down close candles. I don't know which one's the right one, and it's uncomfortable to me. I get anxious about it, but I can see the fair value gap. I can see it when it forms. He told me the time at which to look for it, and then I'm going to use that. I can see that relative equal high. Also, the daily chart looks like it's moving higher anyway because it's just recently ran out sell side, so it's probably going to go higher. And I'm going to only operate and engage price going higher and going long. So fair value gaps, I will look to go long on. Is that complicated? Because that's exactly what I've been teaching. There are tools that help you determine a bias. There's a tool that gives you timing, entry and exits. There's a tool that confirms or qualifies the setup. In other words, it builds another level of confluence to it. It isn't one thing only. It's not a one candle premise. That's what you're saying now. All you need is this one candle. No, you don't. You got one candle to lose your ass. Okay, that's what that is. If you're stripping your logic down to just one candlestick and that's all you're doing, you're going to get railroaded. Period. You have to have supporting logic. You have to know what you're buying, where's it going. You have to know where the stop loss is going to be, and you have to know how price is going to work inside that range. And once it leaves that range, is it worth holding, or is it going above to reverse and go back down, or vice versa, going long? You have to have other supporting actors along with that plot, because the one candle, as much as you want to make that the starring role, the leading man in your narrative, every leading man has to have supporting actors. The best plots have a supporting actress. You have to have a narrative in your trade that your single premise that you're entering on has a lot of supporting actors around it. Market structure, sure. Seasonal tendency, sure. There are supporting roles, but they all don't have to agree. What do I mean by that? Did I confuse you with it? How are you going to time your trade? Like what gets you in the trade? Well, the fair value gap. You buy the fair value gap high or upper quadrant level when it's bullish. Don't try to get the lowest low. Don't wait to get to it. Just look at my executions. You'll see me doing that. Because many times it'll go down there and just touch one tick into the high of it, and it won't go any deeper. And it runs away real quick. And here you are sitting with your limit order at the consequent encouragement or lower because you're greedy and you want a better fill because you want to do more contracts because you want to use smaller stop loss. Stop thinking that way. The volatility of the market the markets right now are making it difficult to have very, very, very small stop losses on all trades. There are times when it can be afforded, but predominantly it's a knack thing. It's an experience thing. You have to know when to do it.